Welcome to the Cryptoverse DAO. Today we're going to be looking at relative strength indexes and what they are in crypto and Forex trading. Before we get started, if you're catching this on YouTube, do remember to like and subscribe and check out our link tree in the description below as well. So what is a relative strength index? The relative strength index, also known as an RSI, is an indicator. It's a momentum indicator, specifically an indicator of momentum, right? So it's used in technical analysis when you look at charts and use chart information to kind of inform the position you're going to take on a trade. This is an indicator that you can use. And what this indicator does, yeah, I said momentum, what it does is it measures the magnitude or the intensity of recent price changes, and it uses this data to evaluate whether the market is in a overbought or an oversold condition, right? So generally, your brain is probably jumping to the somewhat correct conclusion. Yeah, if it's overbought, if the market is overbought, then there should ideally be a correction, and the market is more likely to the price of the asset you're looking at specifically is more likely to correct from being overbought, which would fortify your confidence in taking a sell position at that point. Versus, again, if the market is showing you, if this indicator is showing you that the asset you're looking at is in a oversold condition, then, conversely, you're going to have the same thing. The price is more likely to correct upwards, which means a buy position is the smarter thing to go for. It's displayed as an oscillator, which is a line graph that moves between two extremes, and it can have a reading from 0 to 100. This indicator was originally developed by J. Wallace Wilder Jr. And introduced in a seminal book of 1978. It was called New Concepts in Technical Trading Systems. Traditional interpretation and usage of the RSI are that values of 70 or above indicate that a security is becoming overbought or overvalued and may be primed for a trend reversal or a corrective pullback in price. An RSI reading of 30 or below indicates an oversold or undervalued condition, right? So like I said, it's an oscillator, it's a line graph that moves between two extremes. And people use these 70 and 30 kind of bounds. As you can see right here, this is what it would look like on a chart or on a software like TradingView. You can add this indicator in, just type, click the indicators tab, type in RSI or relative strength index, and it'll add it to your chart. And you should already have these bounds in by default, these dotted lines. This is what it is. It tracks the momentum, the intensity of price changes in an upward or downward kind of direction, right? And once it breaks above 70, around here, that's usually an indicator of an overbought market, like a market that's the asset is in an overbought state. And like I said, vice versa, this is the 30, just to help you visualize it. That's the 30 bound that we're talking about over here. Again, developed in 1978 by Wilder Jr., the RSI provides technical traders with signals about bullish and bearish price momentum. It's often plotted beneath the graph of an asset's price, and like I said, 70% and 30% as the overbought and oversold bounds. Now, it's not supremely important to know this, but I mean, it is always nice to know why. Why this data is being produced, what it is that's producing this data, the math, the equations behind the data that you're seeing. So this is it right here. It's a two-part calculation to calculate the relative strength index of a asset, of the price of an asset. And it starts with this. This is the first part of the calculation, RSI step 1, 100 minus 100 over 1 plus the average gain over average loss, right? The average gain or loss used in the calculation is the average percentage gain or average percentage loss during a look back period. And this is something that can change as well depending on how you use the indicator, and we'll get into that in just a second. So the formula uses a positive value for the average loss. Periods with price losses are counted as 0 in the calculations of average gain, and periods when the price increases are counted as 0 for the calculation of average losses. The standard, when it comes to look-back periods, right, is to use 14 periods to calculate the initial RSI value. For example, imagine the market closed higher 7 out of the past 14 days with an average gain of 1%. The remaining 7 days all closed lower with an average loss of minus 0.8%. The calculation for the first part of the RSI would look like the following expanded calculation, as you can see here. I'm not going to read out these numbers. Once there are 14 periods of data available, the second part of the RSI formula can be calculated. The second step of the calculation smooths the results. This is RSI step 2, right? 100 minus 100 over 1 plus the previous average gain by 13 plus the current gain over previous average loss into 13 plus current loss, right? Using the formulas above, the RSI can be calculated where the RSI line can then be plotted underneath an asset's price chart. The RSI will rise as the number and size of positive closes increase, and it will fall as the number and sizes of losses increase. The second part of the calculation smooths the result. So the RSI will only near 100 or 0 in a strongly trending market. So not in a ranging market like you can see here. Strongly trending. So if you're on a very strong uptrend or a very strong downtrend, that's what that means. As you can see in the above chart, the RSI indicator can stay in the overbought region for extended periods of time while the stock continues its uptrend. The indicator may also remain in oversold territory for a very long time when the stock is in a downtrend. Now, this can be confusing to new analysts, but learning to use the indicator within the context of the prevailing trend. End of the day, any indicator should only be secondary. It should be secondary confirmations. I mean, dependent on your trading strategy, obviously, but generally you don't want to go in with the assumption that, hey, I watched a YouTube video on Cryptoverse DAO. They told me that the RSI tells me that the market's going to go up. And so I entered a buy. And then, imagine it goes into a ranging market, or there's more. Let's say you didn't take a look at the price action, right? And it wasn't, you didn't plot enough, you didn't look for a break of structure or something to fortify your position in addition to the RSI, you're going to lose money. That's what's going to happen. Remember this statistic, and anytime anyone asks you about trading, always parrot this statistic to them. 90% of new investors lose 90% of their money in 90 days. On average, this is what happens. But again, if you remember to always use any indicator or literally any indicator, not even just the RSI. Always use it within the context of the prevailing trend, which you identify using price action, by looking at price action. Then you're less likely to lose money. And at the end of the day, a trade with minimal risk like a minimal percentage of risk, that to me is a good trade. Not the highest percentage of possibility of winning the trade or making money. It should always be the lowest percentage chance of losing money. What does the RSI tell you? Well, the primary trend of the stock or asset, obviously a very important tool in making sure that the indicator's readings are properly understood. So there's a guy called Constance Brown, a well-known market condition, CMT, has promoted the idea that an oversold reading on the RSI in an uptrend is likely much higher than 30%, and that an overbought reading on the RSI during a downtrend is much lower than the 70% level. As you can see on the chart below, during a downtrend, the RSI would peak near the 50% level rather than actually breaking up to the 70, as you can see here. So you can have mini kind of lower, not mini lower and upper bounds. It's kind of like a median level for an adjusted overbought level that you're looking at here. So as this chart shows, during a downtrend, peaks near the 50, this line here, not to the 70. And this can be used by investors to more reliably signal bearish conditions. As you can see, it's making lower and lower and lower lows. Plus, you can see the RSI dipping here. So that's, this sell, you could have caught by using the RSI and price action and potentially a couple other indicators if you want them for that additional confirmation. You see that sell right there could have been taken because you see this dipping down here. You see it making lower and lower lows. No break of structure to indicate an uptrend. All you see is just that, and that's a tick. It's a lower, low risk somewhat. Many investors will apply a horizontal trend line between 30 and 70% levels when a strong trend is in place to better identify extremes. Modifying overbought or oversold levels when the price of a stock or asset is in a long-term horizontal channel is usually unnecessary. A related concept to using overbought or oversold levels appropriate to the trend is to focus on trade signals and techniques that conform to the trend. In other words, using bullish signals when the price is in a bullish trend and bearish signals when a stock is in a bearish trend. That'll help you to avoid many of the false alarms that the RSI can generate. Interpretations. Generally, when the RSI surpasses the horizontal 30 reference level, bullish sign, and when it slides below the horizontal 70 reference level, it's a bearish sign. Put another way, one can interpret that the RSI values of 70 or above indicate that a security is becoming overbought or overvalued and may be primed for a trend reversal or what is called a corrective price pullback. An RSI reading of 30 or below indicates an oversold or undervalued condition, and then the same is true, but in the opposite. During trends, the RSI readings may fall into a band or a range. During an uptrend, the RSI tends to stay above 30 and should frequently hit 70. During a downtrend, very rare to see the RSI exceed 70 and the indicator frequently hits 30 or below. These guidelines can help determine trend strength and spot potential reversals. So if an RSI can't reach 70 on a number of consecutive price swings during an uptrend, but then drops below 30, the trend has weakened and could be reversing lower. The opposite is true for a downtrend. If the downtrend is unable to reach 30 or below and then rallies above 70, that downtrend has weakened and could be reversing to the upside. Trend lines and moving averages are helpful tools to include when using the RSI in this way. Like we said before, it's all about using this within the context of everything else. RSI divergences, let's talk about that. So a bullish divergence occurs when the RSI creates an oversold reading, followed by a higher low on the charts that matches correspondingly lower lows in the price. This could indicate rising bullish momentum, and a break above oversold territory could be used to trigger a new long position, right? So you're expecting the price to now go up and you want to profit off of it. A bearish divergence occurs when the RSI creates an overbought reading, followed by a lower high, which then matches corresponding higher highs on the price. As you can see in the following chart, a bullish divergence was identified when the RSI formed higher lows. As you can see, this is a low. That's a low that's a little bit higher than the previous low. That's all that means. You see people say higher low, lower low, blah, blah, blah. That's literally all that it is. The low is here, the low is here. Now the low is here. There's another low here, and this one, this is higher than this. This is higher than this. This is higher than this. And that's what that means. So as you can see, yeah, bullish divergence was identified. Higher lows, and the price forms lower lows. So you see here, this is forming higher lows, and the price is forming a low here. This low is lower than this one. This one's lower than that one. This is a valid signal, but divergences can be rare when a stock is in a stable long-term trend. Using flexible oversold or overbought readings will help identify more potential signals. Swing rejection. So another trading technique examines the RSI's behavior when it is re-emerging from overbought or oversold territory. This signal is called a bullish swing rejection. It's got 4 parts. So the RSI falls into oversold territory. The RSI crosses back above 30%. The RSI forms another dip without crossing back into oversold territory. Without crossing, right? It forms another dip. and then the RSI breaks its most recent high. As you would, so this, if this had continued up here, I guess you could say, you know, it breaks above 30, dips, and it doesn't cross, and then if it had continued up here and formed a high here that is higher than this high, that would be an example of an RSI swing rejection. As you can see in the following chart, the RSI indicator was oversold. Okay, yeah, oversold. Broke up through, well, no, in this chart it broke down below 70 and formed a rejection low. Okay, so it came back up and it didn't break here. It didn't break back above in the direction it was coming from. And it swung this way and made a lower low than this one, right? So that could be interpreted as a swing rejection in this direction. Using the RSI in this way is very similar to drawing trend lines on a price chart, I suppose. So limitations, let's talk about that. The RSI compares bullish and bearish price momentum and displays the results in an oscillator, as we said, you know, before, an oscillating line graph that can be placed beneath the price chart. And like most technical indicators, its signals are most reliable. I would say its signals are only reliable when they conform to the long-term trend. True reversal signals, excuse me, and can be difficult to separate from false alarms. A false positive, for example, would be a bullish crossover followed by a sudden decline in the price of the asset you're looking at. A false negative would be a situation where there is a bearish crossover, but then the stock suddenly accelerates upwards. Since the indicator displays momentum, remember, it can stay overbought or oversold for a long time when an asset has significant momentum in either direction. Therefore, the RSI is mostly useful in an oscillating market where the asset price is alternating between bullish and bearish movements, not in a ranging market, not in a strongly continuous uptrend or downtrend type of market. And where does the oh, well, I suppose you could say ranging market. Yeah, not, yeah. But you know what I mean. The relative strength index is a measurement used by traders to assess the price momentum, like we've covered before. The basic idea is to literally just measure how quickly traders are bidding the price up or down, the price of the security. The RSI then plots that data on a scale of 0 to 100, readings below 30, as we've said before. Oversold, readings above 70, overbought. Traders will often place this RSI chart below the price chart for the security so they can compare the momentum against the market price. Yep, we covered that as well. What's a buy signal? So some traders will consider it a buy signal if a security's RSI reading moves below 30, based on the idea that the security has been oversold and is therefore poised for a rebound. However, the reliability of this signal will depend in part on the overall context. If the security is caught in a significant downtrend, then it might continue trading at an oversold level for a long time. Traders in that situation would probably delay buying until they see other confirming signals. Absolutely, yeah. The RSI should never, just one indicator, should never, ever, ever, ever be the sole deciding factor in whether you take a trade or, you know, what the nature of that trade is. MACD, right? So the MACD is the relative strength index, and this one's a moving average convergence divergence indicator. They are somewhat similar. So they're both measurements that seek to help traders understand recent trading activity of an asset that they're looking at. But the way they go about this, somewhat different. So the MACD works by smoothing out the security's recent price movements and then comparing that medium-term trend line to another trend line showing its more recent price changes. Traders can then base their buy and sell decisions on whether the short-term trend line rises above or below the medium-term trend line. We've covered moving averages before, so to help you visualize what, you know, a shorter term moving average, like crossing above or below a longer term moving average looks like, do go back and watch that video on the education playlist. of the Cryptoverse DAO YouTube. But with that said, I think that brings us to the end of it. Like I said before, if you enjoyed it, subscribe, drop a like. If you didn't, drop a dislike. All good, you know. Drop a comment, let us know why you didn't like it. Join the community as well if you'd like to. There's a link tree in the description. We got Twitter, we got yeah, it's up here as well. We got everything. So I've been Dharma. This has been the Cryptoverse DAO. Thank you so much for being a part of it. Ciao, ciao.